Hello everyone, thank you to Stephanie for really shedding a lot of light on what we're talking about today. We are, as John mentioned, going to get into the nitty-gritty of EU bonds in the next hour or so. I'm delighted to be joined by Siegfried, whose name you will have heard just now, from the European Commission, overseeing an awful lot of this funding effort on behalf of the European Commission, by two of the banks that support the EU in the markets, two of the primary leaders, from Morgan Stanley, Asif from HSBC, and also Neil Murray from ADIA. And if the other panelists don't mind, I'm going to start with Neil, because Neil, you sort of don't just fit the profile of the type of people the EU is reaching out to, I think you are the profile. And the type of institutions that the EU is reaching out to. You are obviously one of the biggest asset owners in the world, seen as one of the more sophisticated asset owners in the world. And pretty much every government, every company in the world would like ADIA to be an investor in it, I think it's fair to say. So you have to make a choice as to what you invest in. But just to start with, I could ask you to jump in a time machine and go 3 hours back in time from this morning, before you heard from Commissioner Hahn, before the discussions that had just taken place. How much of the story of the EU and your recognition of the EU bond programme, how much of that cut through to you as the CIO of fixed income at ADIA?
Thank you, Clive. I think we've known the EU in all shapes and forms, through sovereign governments, through the supranational agencies. And in fact, I think people, I think Stephanie touched on it a little bit, but these EU bonds, the EU bonds are actually, in some ways, not the first generation. We're going through Sure bond, in fact ESM bonds, which again came through earlier. And it seems like it's just a path whereby people are getting more and more comfortable with some form of issuance from the EU at the top level. I think for us the big question is how do you put these EU bonds into laws? I think that it's a very valid point that there's an EU budget, but indeed it is also true that the EU can't raise taxes. Now, can we say that if the budget is agreed, that it's joint and settled? I'm not sure. And in fact, some of the other aspects of fiscal transfer and everything that matters to bond investors. Ultimately, I think people forget to something. What's a bond? What's a bond supposed to do? A bond is simply that you invest some money, you get a coupon, and you get your power back to them when you invest. Now, throughout the time, you'll see spreads widen and spreads tighten. But I think for us that we absolutely know the story of EU bonds. And the question is where is Europe moving towards to institutionalise those EU bonds? And again, the question for me is, are they a spread product, or do they become a reference product? Do they become what everyone should believe is the reference product for Europe, akin to the US Treasury market being the reference point for the US, rather than one or two states which may be in a better fiscal position than the United States government, but again, not the reference equating Germany to the EU in that context.
We'll come back to that, I'm sure, over the course of the next hour or so. But just tell us about your approach in recent years on investing in Euro assets. We heard earlier in the first time, there was a period, of course, where EU bonds, particularly from someone, had very little yield. You maybe weren't on track. That has changed. But tell us a little bit about your approach currently to your Euro bond portfolio.
So I think one of the interesting aspects in this region is obviously the biggest asset in this region is dollar denominated. Oil is sold in dollars, the market works in dollars, and in fact, therefore, the biggest aspect of the liability and asset side comes to being dollars. I think to your point around the ADIA and sophistication, I think many people forget that you can make plenty of money on a total return basis from owning bonds in the usual look. If you owned a German bond that was minus 20 basis points, but rolls down to minus 80 basis points, you make plenty of money. And the total return of actually fixed income wasn't terrible until we was obviously, it was my theory, 400 or 500 basis points. And therefore our exposure is ultimately about generating returns in a diversified fashion. So we will look at the Eurobond markets as well as the dollar bond markets, and it's really ultimately it's an assessment of the the interest rate environment and what forward curves say, etc. So I wouldn't put it into that context of because yields were low, we were owners. Obviously, that is a sovereign wealth fund, and that's a little bit different to the aspect of the reserve management in the country. ADIA is separate to the Department of Finance for Abu Dhabi, or the Ministry of Finance for the UAE, and therefore it isn't a question of us of having reserves, it's a question of can we get money from the fixed income assets that we own and manage.
What's the approach you take to whether if you are buying euro-denominated assets, whether it's funds or OATs or EU bonds or Spanish, how do you approach that decision?
So then it's again, as mentioned in the other panel, fixed income is everything but relative value. It's a relative value question. Do you believe you get the money back? And you hope for most of the entities you just mentioned, you're thinking that you're pretty far from the fault, hopefully. So therefore, it's what's the relative value at any given point in time. Are EU bonds looking expensive or cheap versus their perceived peers? Do you believe that EU bonds can go from being a spread product to a more reference product? Would that make EU bonds more attractive? Are the French fiscal position getting worse versus other countries, meaning that you think your OETs are going to widen? So it's really a relative value concept in terms of where you're being offered the appropriate spread for the risk of the taking.
Just a final question for now. Is there something inherently attractive about the ability to get exposure to the whole of the EU rather than individual countries?
Absolutely, and I think if you put it in the mind of an investor, if you really believe that they are effectively joint conservative, the EU budget is there and the EU can tell someone to effectively do some fiscal transfer, then in fact as an investor, and being selfish as an investor, I would rather that they don't go in government bond benchmarks because I'm happy to take the extra spread from the fact that people are unsure as to what they are. But from a European stance, I think Europe should want ultimately everyone to get to the point whereby, as I say, that the EU bonds should become something that's more of a reference than a spread.
I don't want a final question, don't answer it if you can't always stay secret. Do you currently own EU bonds?
Yeah, I'm not supposed to say.
Are you minded to own EU bonds?
Absolutely. When we see new issues and we see where things are in the markets, we'll absolutely be involved in new bonds when we see value.
Thank you very much, Siegfried. Tell us a little bit about, in the 2.5 years or so that the EU's been issuing, how your investor base has been changing and the evolution, particularly in terms of non-European investors in EU bonds.
Well, our investor base is developing, is growing. We are having in the meantime more than 1,700 investors being active in the primary market of our bonds. And we have here, when we talk about this number, to take into account that we have also a lot of investors who are buying us in the secondary market. We don't know the names. Just an anecdote, I was seeing an investor, a large one, public sector, in 2022. And he was very enthusiastic about EU bonds. And exactly 1 year later, I was seeing the guy again, and our investor relations team prepared me, and I saw this investor bought 50 million over the last 12 months in our books, which I found a bit disappointing. In the meeting, he was again super enthusiastic about EU bonds, and then I raised the question. I said, happy to hear that you like the EU bonds. I saw only 50 million orders from you in our order book. What's the reason? The reason, he said, this is wrong. I bought over the last 12 months 1 billion. But I bought it in secondary markets because now your secondary market is liquid enough, deep enough, that I can buy what I want, when I want, and don't have to wait for your issuances. And then I want to buy 5 years and issue 10 years and other things. So the 1,700 I mentioned is only the primary market. There are even more in secondary markets, and especially the large players outside Europe. And it's important for us that we develop this investor base because we develop our supply. We heard it this morning, end of 2019, 50 billion outstanding. In 2019, if I remember correctly, 500 million of supply. Now, almost 500 billion outstanding, and an annual supply in the last years of 120 billion. In the upcoming years, until the end of 2026, is expected to be more in the area of 150 billion. So if you have more supply, you have to develop the investor base. But the good thing is, it's not so difficult, because it's a win-win situation. There is a egoistic motivation, of course. We have to sell our bonds, and there's nothing wrong to have this motivation. But EU bonds represent, and this is why we call this conference that way, an opportunity for global investors. An opportunity to invest in a very liquid, safe asset in Europe, in a mix of in the whole European economy. I'm not picking a single areas out of it. And this is currently a very attractive yields, offering spreads. You're mentioning a spread product, but we are in the transition to a reference product. We heard it from Stanley. So it's currently really an opportunity, and it's a win-win situation. It's an enrichment for portfolios of investors, risk diversification with yield pickup. So a great opportunity.
It's easy to forget that it's still very early days in terms of building your investor base as well.
Yeah, and it takes time, because the market has to realize what is this new asset, the EU bond. And when we started to become bigger in 2020-21, yields in Europe were quite low, negative. Many investors were hesitating to invest in this. Investors have to adapt to this new kid on the block, to adapt investment policies, to adapt risk policies, to make limits available. So all this needs time. In the early days, 2020-21, with the negative yields, it was not so easy. But now we are even more liquid, we have grown, and the yield environment became much more attractive for investors. So especially at the moment, we see a lot of this process is getting traction. From outside Europe, in between 2022 and 2023, the investments from the MENA region increased by almost 50%. We see new investors from regions like Asia, but also from Australia and Canada. And not only the public sector, but not only the public sector. Pension funds, asset managers, insurance companies want to diversify their currency portfolio and are looking for an attractive liquid safe asset and see that the EU bonds are here a great opportunity.
You spend a lot of time talking to investors, not just talk a lot about the EU bonds themselves, but in those discussions with investors around the world, how much you also sensing that they are interested in Europe in itself as an investment destination?
Also, this interest is growing in the past years, mainly driven by the motivation to diversify risk, also risk in not only currency risk, but in which economies and areas they are investing.
Thank you, Siegfried. Let me come to Ben and Asif. Ben, let me come to you first. So from the point of view of being a primary leader, being active in primary and secondary markets on behalf of the EU, and of course pretty much every other sovereign in Europe as well, how have you seen that evolution in investor attitude towards EU bonds over the last 2.5 years?
Yeah, I think it is a real evolution. And if I were to look at sort of the investor base pre-NGU versus now, some of the shifts are subtle, but some are actually quite sizable. If we're to sort of run through the investor, the types and go to the geographies, I think that on the central bank and official institution side, quite a few have already migrated the EU from a supranational or agency issuer to the sovereign portfolios. That helps them invest out longer past 10 years, so traditionally they were capped at 10s, but now they can go longer. On the fund manager side, Siegfried mentioned some of the ones from the Americas and the Middle East, but I think what's important not to forget is that in Europe, the fund manager breadth has materially widened over the last 3 years, but equally, where traditionally they've been a rates portfolio asset, we're now seeing the credit side also use the EU as part of their investment universe, whether that's to hedge their credit portfolios or just to offset some of the rating risk they have in some of the lower rated credits, is something where it's just used much more widely within the European fund manager universe. Bank treasuries equally have done something similar to central banks, where some have moved it over to the sovereign portfolio, which means they can invest out past 10 years. And then I think lastly, hedge funds, which we always sort of have a sort of asterisk next to the hedge fund community. they are extremely important for liquidity. And I think historically they've maybe been a little bit smaller in EU pre the NGU program, whereas nowadays they're actually quite sizable. They come into syndications, they come into auctions, they help provide another liquidity avenue for investors. So that's sort of in a nutshell how we see the evolution of the investor universe. I think if you go geographically, clearly the EU still remains the biggest investor base currently, but I think in Asia, they're obviously extremely important geography for the EU, for anybody going out to issue debt. But what we see with Asian investors is traditionally they're sort of a little bit more conservative in their approach. They like to see a track record of an issuer coming through regularly, frequently, transparently, and in large size. And the EU's done that since the start of the NGU program. So that track record has really been built, I think. And we're seeing an increasing amount of capital from the public sector in Asia coming over to the EU. And then, within the Middle East, that's why we have Neil here and everyone in this room, there is still some work to be done in the Middle East as well as in Asia. I don't think the EU has quite yet unlocked the full potential of this investor base. But we're certainly on the public sector side seeing much more activity from Middle Eastern accounts in the EU.
You mentioned bank treasuries and asset managers also in this region. We have a few in the audience today. How much interest do you see from that, or potential is there in those areas of liquidity and investment?
Yeah, they're significant. I mean, I think if you look at the bank treasuries as a whole, the EU has yet to migrate within one of those portfolios over to the sovereign side. And when you look at the risk limits and credit limits that are available for supranationals and agencies versus sovereigns, they're just not really comparable. So there's a lot of room there to expand. And then on the fund manager side, again, it's similar to bank treasuries in terms of the lines and the limits are much larger for sovereigns. But fund managers are typically a little more flexible than bank treasuries. Obviously, bank treasuries have to be focused on HQLA levels, haircuts, etc. And I'm sure there is some focus on that from the fund manager community, but they can be more flexible in sort of reacting more quickly than bank treasuries can. So whilst it's a similar scenario where they haven't yet all migrated over the EU from supranational to sovereign, it's already taken place at some of these accounts, and again, the difference is significant.
So you see that because your counterpart at the other end of the trade is still on a different desk than they were before, or?
It's a little bit nuanced, and this is where the difficulty comes in for the EU. A lot of the time, the portfolio managers are the same people invested in supranationals and agencies as the ones that are invested in sovereigns. There's no two ways around it. There's very few investors that actually separate out the portfolio managers between the two. And so you actually have to go out there, get on the road like Siegfried and the Commissioner have been doing, seeing these accounts, making sure you're proactively pushing them to consider the change. But it's really, it's feedback that comes via all of the primary dealing group back to the Commission as well as the individual bilateral meetings they have with investors.
Basically, the market maybe is speaking before the indices or the rest of the infrastructure as well. Asif, to come to you now, same thing. Just explain to us from HSBC's point of view how you see that evolution in the EU investor base.
Yeah, I mean, first of all, I think as Ben highlighted, since the inception of NGU, we've seen a huge shift in the investor base. But then thereafter, there's been two steps that have materially leapfrog the progress of investors. One is the unified funding approach, as already mentioned by Stanley and Siegfried. Clearly, after the unified funding approach, we saw not only an increase in demand that's led to the record order books we've seen for EU, but actually a shift of demand from an international investor base perspective. We saw the international component in primary trades, in particular, double almost, so an increase of 5%. From investors, and particularly from investors out of Asia and even the Middle East, where we had the feedback that the EU issuance now is more simplified, larger, and liquid. And I think that sums up the unified funding approach quite nicely. So that's bringing in more capital, from the regions like Asia and the Middle East. The second was some of the quoting obligations that have been put in place in terms of MTS, and I'm sure we'll come on to that in a bit more detail. But again, as I mentioned, the ecosystem that has been put around the EU debt is increasing is very sovereign-like now, and that's had a positive impact. Once the MTS quoting obligation was put in place in November last year, we saw volumes in the secondary market double from October to November. So that shows you that the liquidity is increasing. We saw bid offers decrease. So I think 10 years and inwards, bid offers are a fraction of a basis point, which again, in some sovereigns is also not there. So you've got an improved product, so to speak. So I think, there has been, of course, the large funding volume that has been put in place that in itself is an attraction to investors. There's the common debt perception that again is attractive to investors, but then there's some detailed infrastructure that's being put around it that is helping investors increase their capital dedication to EU. So from our perspective, the infrastructure is very important alongside the rest of the points that Ben and you mentioned, but we're seeing that come in place and it's a very positive change.
So where do you now place the EU on the European sovereign spectrum? Obviously the yearly volume is very high, but the outstandings are more like a middle size European sovereign.
It's a fantastic question. I mean, we are responsive to what the market's doing as a primary dealer, as Ben was mentioning. Our job is to facilitate issuer and investors. So we are, responding to what the investor community is doing. And what we're seeing here is these changes that have been made more recently, the increase of liquidity, the repo facilities, all the points that have been highlighted previously. We're seeing not only a shift in liquidity volumes, which, as I say, are increasing, by a significant magnitude, but we're then seeing a shift in perception from people as well. So for the EU, up until recently, France was the perfect proxy, and I think one of the panelists previously was mentioning France as a good proxy for European debt as a whole. And now we're seeing EU take over that perception, and the proxy is changing. So now when we're speaking to investors, we're hearing more and more investors talking about Austria or Netherlands as a hedge versus the EU rather than France. And indeed, if you look at EU bond performance recently, EU bonds past 10 years are trading through France across the curve. So we're seeing a shift in mentality from investors where the proxy is changing from being France to the lower yielding debt. And I know you probably wouldn't like that from his portfolio return perspective, but that is what we're seeing from the investor community.
So you see in the order books or the trading books for owners of EU bonds that they are mostly switching out of other EU bonds rather than it's new investment coming in because it's a new type of exposure to the EU.
It is new investment coming in for the most part. It is new investment, and there's been a huge amount of inflows into fixed income as an asset class as a whole. So it is definitely new money coming in. But rather than viewing the RV or the relative value for EU versus France and how it trades as a spread, they're now looking at the relative value versus, say, Netherlands or Austria, which clearly are trading much tighter spreads.
Thank you. And then just one final question for the participant now. When you look at an order book, say for a France syndication or Spain syndication or similar, are there differences in the international allocations to what you would see in an EU syndication, for example? Or are they broadly in line?
By international, do you mean outside?
So it means ex-Europe, yeah. So the investor base for, say, a France syndication versus the EU syndication, would you see similar non-European interest, or would there be differences?
Yeah, it's a good question. I think there's probably, it's slightly mixed. I think versus a Spain, the EU also has a high credit rating, so it's more eligible across a broader spectrum of investors globally. I think when it comes to France, I think the perception is probably that still France remains slightly more liquid than the EU, which again brings its own sort of additional advantages on the investor side. But I think if you were to go geographically, and France is really the main complex, I think for Spain with a slightly lower rating, you are eliminating a certain group of investors from the get-go. So certainly versus Spain, the EU has a much broader international investor base at the moment. And then I think versus France, it's exceptionally similar. France may benefit from slightly larger orders at the moment, just given the perceived liquidity uplift. But it's not as though everyone's not buying the EU because of it. It just means they're adjusting their order sizes as a result. So for me, at the moment, we're seeing a fairly uniform investor base between the EU and France on senior positions.
Anything different, Asif, on that?
No.
Let's talk about liquidity. Even the most liquid issues, with the exception of US trade, but even the most liquid issues and the biggest issues worry about liquidity. Because it's a key concern of investors. Siegfried, maybe you can tell us a little bit about what the EU has been doing to enhance and maximise liquidity of your issues.
Liquidity is, from the very early beginning, from the design of our whole funding concept, a core element. Obviously, because liquidity and ratings are both main determinants for the price. We consider this at the beginning, building this what we call originally diversified funding strategy, issuing large and liquid benchmark bonds across the curve, from 3 to 30 years. It's part of the design of our primary dealer network. We have 37 primary dealers who are supporting us and who are rewarded via syndications where they get a mandate. But to be eligible, they have to have a minimum share in the secondary market. So we encourage them to trade our bonds in the secondary market.
Encourage is very polite.
The way we act in the market, that we continue to increase the auctions as a tool to issue our debt. It is visible that if you issue a bond via auction, this has a higher impact on the secondary market turnover, because the bonds go to large extent at least to the books of our banks, and then they have to manage the risk, they have to warehouse the risk, they are offering switches to their clients, the old one is sold, the new one is bought. So there's a number of follow-up trades. Also here in this design, liquidity plays a core role. And then we implement a lot of steps here, as you then mentioned some. We implemented the unified funding approach, where we moved away from, for each funding policy we have, we issue dedicated bonds, we put everything under the umbrella of EU bonds. This increases the outstanding volume, this gives a more homogeneous curve, and so increases the liquidity. The holding obligations we implemented with our primary dealers in November last year had a massive effect. Stefan mentioned 118 billion of turnover in January this year. This is the latest quality assured number we have. The not quality assured numbers we got currently analyzing show that the trend continues. And now we are implementing to launch a repo facility in the second half of this year to also support here our primary dealers by being a backstop for them. So this makes it easier for them to quote our bonds in the repo market and in the secondary market. So we are really doing what we can to support the liquidity of our secondary market. And when I talk to traders and to investors, then I think we are on a good way here. Numbers have shown that. So what is now needed is that more investors, more market participants make this opportunity available to their own portfolios. Because we heard that investment allocation to sovereign desks or supranational desks is an ongoing process at the moment. The treatment in investment policies, in risk policies, the treatment in collateral agreements, in tri-party repo baskets, it's to the benefit of the parties of the tri-party repo to have a very liquid and very safe and, from a yield perspective, very attractive asset eligible for this basket, to use it as collateral. This is something we can only explain and promote. The market has to take the opportunity. So it's not only up to the issuer, we are providing the opportunity, but each opportunity which is provided needs to be taken. And this is what is now happening, and where we are making good progress.
On a scale of 1 to 10, Siegfried, how much is the market taking that opportunity at the moment compared to where you think you could get in the end?
7.
Well, that's pretty good.
So I think it moved maybe from, over the last 2 years, from 3, 4, 5 to 7. And I said 7 because I still see room for development. In many cases, as I mentioned, cases for investors, when I look at primary dealers, not at the ones here today, but when I in the morning open my email account and I get the emails from the SSA desks telling me how EU bonds perform versus EIB and ESM, and then I'm getting the emails from the government bond desks telling me how bonds perform versus OATs and that here's a trading opportunity. This annoys me every morning, and I'm waiting for the moment where they send me an email showing me and investors that there's an opportunity to trade EU bonds versus France versus Austria versus Germany or any other sovereign bond. We have to achieve this change in mindset and perception of EU bonds.
I want to come back to that with the other panels in a second, but I just wanted to ask you also, most of our focus today is on the longer term bonds, but there's also the EU Build programme as well, which I think is part of the continuum that we're trying to create. So could you just talk about that briefly?
But also our build program is from the very early days a crucial element because it helps us to manage liquidity. The nature of our outflows is that they are very often concentrated. We are funding the money continuously via our bond issuances, but then you have peaks, and then we have the build program to use that. The build program is, on the other hand, also an opportunity for investors who want to park their money at attractive yields just for a few weeks or months in the euro. So here, decent investor base are the reserve managers outside Europe. And we have here a strategic minimum presence in the market to make sure that, and to give investors confidence that there's always sufficient liquidity in the market. It means we are issuing every new bill with minimum 1.5 billion. 2 weeks later, we tap this bill, minimum 1 billion. And then 3 months later, we do 2 additional taps, also minimum 1 billion. So this is a strategic decision from our side to ensure a minimum liquidity independent from our liquidity needs. Should we have the need for more money, either be larger taps, because this is from an issuer perspective the purpose of the build program, to raise temporarily money in the money market at the short end before you then roll it into the long.
So currently the curve goes from that short term to 30 years then. So,
yeah, we have 6-month bills, which are tapped when they are rolled down to 3 months. So in both maturities, there's every month supply by auction, and then we start our bonds, new bonds with a 3-year maturity bucket, but they are also tapped, rolling down until they are 2 years. There's no written rule. But at one point, it doesn't make so much sense to tap a bond. It's a small bill. And then the maximum maturity is 30 years or beyond 31 years, to be precise.
thank you, Siegfried. Let me come to you again, Neil. You talked about your principal decision being on relative value, but how much is your decision also based on relative liquidity?
I think they go hand in hand, and actually I would disagree with you. The SEC is very worried about US liquidity. In fact, some of the recent rules are all about the worries that the US government has on the liquidity of the treasury market. So I think that when you put it into what the EU want to be, a risk-free fixed income instrument, liquidity is key. People own fixed income as a means of holding some liquidity in their portfolio. Of course, there are many aspects of liquidity in your portfolio. There's the immediate need to sell, there's the lower volatility nature of fixed income versus risky assets. And going back to some of Siegfried's points, the other thing is then the future and the potential question of having futures. Having futures on EU bonds again then just turns it into a more of an institutional government bond type instrument as opposed to anything else. But I think one of the risks on the other side is to some of the points Stephanie made earlier, that this question of is there a sunset date or not? Do securities become assets of the future, because in the fixed income markets it's very well known that issues become less liquid day by day. Every day there's an incrementally small drop in liquidity of any bond. And actually the issuance market is what keeps that market alive, and it keeps liquidity there. There's one of the big points of the issuance market, and these guys know very well, is that it frames where there's a big demand for a book. And that's what keeps people willing to make markets, and make markets from the sell side to ensure that there's a tight bid offer and there's liquidity there, because there's some level of price discovery that can be done through auctions or syndications. And in fact, going back to the futures point, I think Ben's point, one of the probably ways to even explode the desire for hedge funds into those primary books is to have a future, because that's then how you can hedge that book much better. And in fact, having the future may be that you say, well, if I do have a future, that means they can just trade the future rather than actually lending the money. But the whole ecosystem of the future market means that at some point someone's going to lay off some of the risk from the future. So I think it's clearly a big issue, and we see it. You see it across the European government bond spectrum. You see, just because something's AAA doesn't mean to say it will trade tighter than something else, because if there's no liquidity, then investors in fixed income have always got to say, it's not about liquidity when you're getting in, it's about liquidity when you're getting out. And you need to be sure that someone's going to be there to buy those bonds when you need to raise some cash.
And do you tend to buy, you just mentioned that new issue market is very important, do you tend to buy in the new issue market, or you're completely agnostic about when you buy?
So it depends. I think one of the key pieces that these guys tell Siegfried Ruhl is investors want surety of execution, particularly now today. I would say more than 20 years ago, when I was in fixed income markets, you could trade secondary and people would be very happy in secondary. Now, in a lot of markets, you see better surety of execution in the primary market than you do in the secondary market. And therefore, that's what people want to see. The secondary turnover, or if you look at the numbers of secondary turnover versus the size of the outstanding debt, we're in a parlous situation versus 2008. The percentage of secondary turnover versus the outstanding size is much, much less than it was pre-GFC. So therefore, the primary market matters, and having good execution in the primary market matters. Investors don't want to see issuers make the one super expensive in the primary market, such that they take all of the juice of premium out. So there's always got to be a bit of a dance between investors and the issuer and the syndicate and DCM desks. So I would say that it's somewhat ambivalent, but investors expect to get good execution through primary.
Thank you. Just on that futures market, is the evolution of the futures market for EU bonds in some ways dependent on a decision on the future of EU bonds post 2026?
Definitely. I mean, finally, the decision is not taken by the issuer, the decision is taken by the market, by a derivatives exchange who has to launch the future. The topic of a future on EU bonds is discussed since the start of NGEU. At the beginning, very different views. Some market participants wanted to have it immediately, others wanted to wait over time. There was a consensus that maybe the EU should have around 500 billion of outstanding debt. Wherever this 500 is coming from, I'm questioning that this is based on a deep analysis. It's more feel-good number, I think. Now it became clear that this year we will reach this 500 billion, and at the beginning of this year the discussion accelerated again. We are monitoring this discussion, we are observing this. We as an issuer would be happy to have a functioning future market, because it's in general good for the issuer, and we are happy to support that within the limitations we have. Supporting it by issuing bonds to keep the relevant basket liquid, but we can only issue what is needed to be issued. So issuance is per se not an objective. And here the long-term perspective comes into plays a role. What we are saying is we have to issue 150 on average, likely something in this area until the end of 2026. Afterwards, we have to roll over our debt, which will, for the next 10-15 years, can roll over needs of 50 billion, 40 to 50 billion, which will represent the floor of our issuances. Political decisions for new joint financing will increase this number, but we don't know about these political decisions. And now it's up to the market to decide, is this sufficient? Is there sufficient liquidity there that we can launch a future, that we want to launch a future, and do we need a future? We also have to be realistic. We are working on this transition into the EGP market, with the government bond market. We will trade more like a sovereign, so the correlation to bonds and OATs will increase. The correlation to bond and OAT futures will increase. So, does the market really need another EU future? For us, but it's not our decision. So, the outcome at the moment is, I think, that market participants agree that a liquid future market requires also a liquid repo market. Now, market participants are monitoring the development in the repo market for EU bonds. Market participants will wait for our participation in the repo market and see how this continues there, and may discuss it again later this year.
Thank you, Siegfried. Asif, of those measures that Siegfried mentioned around creating and boosting liquidity, from dealer quoting to his encouragement of guys like you, to the introduction of repo, which of these do you think are having the biggest impact?
It's a very good question. I mean, again, I think all of them really are equally important to a certain extent. I think the EU as an issuer has put in place all the ingredients you need to allow a more liquid market, and as a consequence then a future will likely develop, is our opinion. I think, as Siegfried highlighted, by the end of this year, you'll have all those ingredients in place. When you speak to the traders in the repo market, you're using electronic platforms now. They're seeing month-on-month growth of 30-35%, which is huge. Once the EU is going to be active in the market as well, I think that's the final piece of the puzzle that needs to be put in place. But if you come back to Neil's point, liquidity is driven by primary issuance. We fundamentally believe that. I'm sure Ben will attest to that as a primary desk as well. But it's two things. It's the size of bonds, which is of course very important, and EU have very sizable bonds comparable to sovereigns. But it's also the cadence of issuance. And here again, EU is active in the market and in a very transparent fashion, given the kind of 6-month funding exercises that the EU is doing. So I think from that perspective, again, when you look at all the ingredients needed, it does feel like it's there. The liquidity is very strong at the moment. I was in fact in that meeting with Siegfried, where that Asian investor mentioned, and again, it tells you how easy it is for some of these large investors to get access to large quantums of EU bonds. And again, one of the reasons why he wasn't involved in primary was partially because of the ease of availability of bonds in secondary. Now, of course, from this point, you do miss out a little bit on that kind of supply concession that's offered in primary, but that's something that they were willing to do because the bid offers are very small now. So, from our perspective, we're very confident that the liquidity will continue to increase as the investor base continues to grow, and all the ingredients from an issuer's perspective are going to be put in place that will allow for further development of the market. And in my opinion, that will end up being potentially a future market as well, as long as we have some view of future issuance, which even if the NGU funds or the RFF funds aren't repurposed, we still have an ability to see EU funding 40 to 50 billion a year to roll over financing. And of course, there's a big question about Ukraine as well, and EU support for that. So I think that's enough for a medium-sized sovereign going forward as well, and that should be enough for the futures market to develop.
Can you just talk a little bit about the dealer quoting commitments as well? Because not the primary dealers here today, but I've heard primary dealers for other sovereigns that question whether quoting commitments are necessarily the right way forward into increasing liquidity. How do you see that?
it's important as a bank, we're of course here to provide return to our shareholders. So, we need to be encouraged, to use the word Siegfried used, to of course be actively participating in debt and dedicating balance sheet towards that primary dealership, and in this instance the EU debt. But equally, we don't want the rules and the obligations to be too onerous that is more costly than what the reward is. I think the EU has struck the right balance at this stage. There are other sovereigns who have too strict obligations, and that means that banks end up pulling back eventually from those primary dealerships. But we've seen most of the sovereigns, be a bit more relaxed about reporting obligations at times, stress, for example, or of course to understand the bank's position. At the moment, as I say, EU is still an attractive opportunity for banks to continue to dedicate balance sheet, so that there is that primary dealership infrastructure around it. And from our perspective, the reporting obligations have been helpful because it's increased the liquidity of the market as a whole, which again, as a bank, allows us to recycle risk as well, which is important for us.
Thank you for that honest assessment. Ben, so a question around liquidity. What are your traders seeing as well? And what impact do you think the plans for the repo facility will have in particular? Because I think that's a pretty crucial thing. Not every sovereign has that, obviously.
Yeah, sure. So I think on the liquidity point, I think it's materially improved versus 3 years ago, versus a year ago, versus 6 months ago. So the evolution is in the right way. I actually think, Neil mentioned Asif as well, around investors putting programs through in the secondary market because there's liquidity there. I actually think the half-yearly funding plans, the auction dates, the syndication dates are incredibly important because there are some investors, particularly on the public sector side, who will only put through programs via auctions or via syndications. That's where they feel most comfortable, that's where they feel like their activities least known. And so the fact that the EU has introduced these second-hand funding programs just gives that sort of reassurance, certainty about when they come into the market. So that's definitely been a benefit. And I think on the quoting side, you've got probably outside of the fence where, from a pure advisory perspective, it's a no-brainer to have quoting obligations and market-making requirements. I mean, it provides transparency to the investor base of where the actual market is. It provides transparency on bid offers, etc. If you were to speak to trading desks, then of course they want full optionality, as every trading desk does, as every property investor does. You want optionality about when you quote and what you quote. But from the smooth functioning of a bond market or fixed income market, the obligations obviously contribute towards liquidity. So from that perspective, I think it's an absolute no-brainer. What's been done, and it has been obviously very successful in promoting liquidity within EU bonds. And then on the repo market side, as you mentioned, not every sovereign has a repo facility, but I think what the EU is doing with this piece of the primary dealership as well as others is they're sort of taking the best parts of each debt management office and each government bond market and rolling it into one. And so when you think around, again, what I mentioned around optionality, it's I think the same from the investor side, the bank side, but also within a predictable set of guidelines, issuers also want flexibility. So introducing the repo facility from our perspective provides more functionality, more optionality within the market about how you use the debt, when you use it, etc. So it's it doesn't make or break the EU market by any stretch of imagination, but it provides another helpful tool for banks and market participants to use.
Any comments on that?
No, so far. I'm happy to hear that we're on the right way. This is encouraging, and we will continue that.
Super. We're coming down to our last 10 minutes, so I'm going to just quickly look at the room and see if we have any questions from anybody with us today. I can see my friend Mr. Orchard over here with his hand up. So you want to, you can start projecting if you want while we wait for the microphone to come.
A little off the beaten track, but whether Siegfried is going to get on the sovereignty loans have in the form of
inflation-linked bonds, public hurricanes, and maybe block. Right, the answer.
Well, if we talk about the foreseeable future, what we know we have to fund, the remaining funding needs for Next Generation EU, for the Ukraine facility, and some other smaller programs. We will stick to what we have implemented and continue to implement. We try to harmonize our curve, to concentrate liquidity so it doesn't make sense to add additional products and then to diversify it again. This is counterproductive and gets the objective. So this is our medium-term plan, and if the environment framework changes, we can discuss again, but for the moment this is what we have.
And if I was to add, I would say that the series answer is perfect. You know, inflation like bond tax is a big failure. Other than the UK, France, and the US, there's no liquidity. In fact, even if you look at liquidity of TIPS versus liquidity of treasuries, it's terrible. You know, just last year, year before last Canada said we didn't want them anymore and getting rid of them. I think that ultimately they serve a purpose where people have a specific pension scheme or rules around requirements from a defined buyer. Otherwise, they haven't been fantastic. And even just to the earlier point, I would say, most sovereigns don't actually borrow in other currencies. So actually, sticking to euros and doing it in euros actually keeps it on that path of being homogenous and a reference type of issue.
I think the thing I learned about inflation bonds was that issuers only want to issue them when investors don't want to buy them. And investors only want to buy them when issuers don't want to issue them. And there is the problem with the market.
The swap market is fantastic, but the bond market not so much.
We're running out of a little bit of time. Any other questions from the floor? Yes, we have one just over here, please.
So my question basically is for Neil. You said a very important point regarding having a highly rated credit bond doesn't necessarily mean that it's liquid. So in our case here, how would I assess or determine that the market for EU bonds is liquid enough for me to start investing?
So I think it comes down to a couple of the points that Ben Asif made. Essentially, the turnover numbers. So looking at the turnover on a day-to-day basis, weekly basis, etc. Looking at the bid offer. The bid offer is how tight that bid offer is, and how variable that bid offer is in different times. You know, when if yields are moving higher, how much wider does that bid offer get versus when there's not much volatility in the markets. And everything else in infrastructure, you know, so the bond become much more liquid when a repo market is there. Absolutely. The bond become more liquid when you have these regular funding periods and a known issuance calendar from investors. If you're asking me, are EU bonds liquid today, I would say absolutely. You know, even just any of that discussion of moving closer to the spreads of Holland versus France is an indication of that. There is no right answer and wrong answer. You know, as I say, I disagree with Clive. The US is very worried over treasuries because during COVID, everyone wanted to sell treasuries and no one wanted to buy them. Not that I agree with the measures that they're coming up with, but they are with liquidity. So you can never say, there's never an absolute in the fixed income world, there's never a specific answer. But everything the panel's been talking about is a good sign.
Maybe just a couple of things on our side. I think we've had similar questions from investors as well around when's the right time to enter. And I think I'm sure Asif and his team and my team, we've been asked numerous times what do bid offers look like on a historical basis in various maturities. I think one way to sort of test that, and it's not necessarily the most scientific way, is we've had 3 or 4 investors come to us and test us plus 3 or 4 other banks sort of on a weekly basis, but without specifying the exact time where they're going to check us on bid offers, what we would charge for 50, 100, 150, 200 million clips, and then you can monitor that over time, such that when you decide to potentially pull the trigger, you can see if that matches off either in times of stress or times of sort of fairly benign market environments. And then, the bilateral meetings with the Commission they can give you a lot more data than we can in terms of the absolute numbers. And I'm sure they can, Siegfried and the team will go into them bilaterally, but that will give you a much bigger sense when you compare that to some other sovereigns of where exactly they fit in from a liquidity perspective.
And I would just add one last point, which is the ultimate demand picture as well. And I think the Commissioner mentioned it previously that, adding EU bonds to these indices will also create a structural demand, which, again, if we do see the ICE consultation come to an end in a positive fashion, that will have hopefully a snowball effect for other indices. Definitely been the pressure to consider such changes, and that unlocks a huge element of structural demand out there. I was reading earlier that this year, 2024, passive investments have actually surpassed active investments in the US, $13 trillion equivalent. I don't think we're quite there in Europe, but clearly that trend is huge. And passive investments and index investing is a huge trend that is continuing to grow, and that structural demand will also increase, of course, the demand for EU bonds and maybe chip away at some of the attractive relative value that's out there, but it will increase liquidity ultimately.
Any other questions? Yes, one just here, please.
Question for Siegfried. So recently we saw your on your bond syndications that you're pricing against mid-swap, which helped the attractiveness of your bonds. Have there been any thoughts, discussions in this perspective of liquidity or pricing against government benchmark or against your own curve?
This is one of the points which is also mentioned in the discussion about transitioning to the government bond market. Not one of the most common things. We currently stick to pricing to the versus the swap curve, as the swap market is really deep and liquid, and you also have to make sure that you have some stability in the market when you price bonds, and our issuances can have 8, 10. At the beginning, the largest syndicate issuance we priced was a 20 billion bond. But in the meantime, we are in the area of up to 10 billion per transaction. We must have a market which can digest this as a pricing reference. Moving then to the government bond market, of course the bond market is also able to digest that, but it would be just another pricing reference. I think the major step would be to price versus the own curve, but here while we are quite saying our market is quite deep and liquid, we are also realistic, and it's just for reputational reasons, pricing versus the own curve doesn't make sense. So we continue to develop our market until we have really the confidence that the market is sufficiently developed. And also here repo market plays a role that we can at one point price versus our own bonds, or foresee the future price versus us.
Thank you, Siegfried. My last question to you, Siegfried. John mentioned earlier that some of the research we did on OMFIF around central bank reserve managers, we're seeing a higher allocation to euro-denominated assets, clearly buying EU bonds is an option for those central banks around the world, including here in the Middle East. But how much is it a goal to be seen as a safe asset as an EU, or how much is it more that will be the consequences of the decisions you make and get correct in terms of building that liquid, high-quality asset?
The goal is to be priced and traded in a way which is appropriate for the issuer and the nature of the issuer. We heard in Stephanie's statement in Commissioner's speech that the EU is not a sovereign, but it's also not a typical SSA issue where it has sovereign elements, the budget-based financing. We have legislative power, 80% of European, national European law is based on European law. We have judicative power, the European Court of Justice stands above the national courts. We have a European Parliament, we have even a European citizenship. Member states transfer their sovereignty to the EU. Then you combine this with the market perspective. We discussed the liquidity, the way we act in the market, the this is sovereign style. The size with this 1 trillion end of 2026, almost 1 trillion, we exceed the combined outstanding amount of EIB, EFSF, ESM, and KfW. And we are the 5th largest issuer in the European government bond market. There was the argument about taxes from Neil at the beginning. Depends on how we define tax. But I wanted to raise one point that first, Stefanie mentioned that our taxpayer, the 27 member states, is always paying. Second, it's true that most of the EU budget is funded by the GNI contributions, but we have also direct income from custom duties and so on. And this direct income was, if I'm not mistaken, 28 to 30 billion in 2022, which covers almost the full amount of future maturities we have. So even without GNI contributions, our direct income is covering a large share of our maturing debt in the future. So it's really safe, it's liquid, it's by nature somewhere in between, but maybe closer to the sovereign bond market and should trade like the sovereign bond market and should be compared to the sovereign bonds. It's not about ego that we want to be seen like sovereign or any political objective behind it. It's a fair, proper pricing according to the nature and type of issuer and market size.
Thank you, Siegfried. And I think it's just worth taking a step back and remembering it's 2.5 years since you started effectively. And I can't think of another issue that's created such an impact in such a short space of time as the EU has, albeit obviously there's some pent-up demand for what you're doing now as well. We're going to take a break for lunch now. We're running a little bit late, and so I think we'll restart around 2:15. But in the meantime, please all put your hands together for the fantastic group of panelists.